Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank using the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sari Ibrahim. With us today, I have a very special guest. His name is Matt Picheny. He is a real estate investor, Tony Award winner, and author of the #1 best-selling book, Backstage Guide to Real Estate. He is focused on developing passive income streams that enable investors to write their own story and choose how they want to spend their time. Matt has over 15 years of experience revitalizing and elevating communities through real estate investment and has invested in over 8,000 apartments nationwide. He is a licensed real estate agent and has earned both commercial real estate and real estate finance certificates from Boston University. Matt is a member of the Forbes Real Estate Council, the Fast Company Executive Board, and is an advisor to a pro tech company. Matt, welcome to the show.
Oh, thanks for having me. It's a pleasure to be here.
Yeah, thank you. As you probably know, and the listeners probably know, like one of the roots of the show is real estate investing, along with other things like infinite banking and financial planning and other parts of managing money. Before we jump into real estate, let's talk a little bit more about your background. So how did you get into real estate?
Sari, think about where you were in 2001. Okay. I lived in New York City. I had moved to New York to be an actor and got involved in digital marketing. And I had a digital marketing agency. In 2001, the dot-com bubble burst. And so my business was imploding, right? Digital marketing, any clients that I had either were going out of business or they weren't spending money on any digital marketing projects. I get home one day, get a phone call from my landlord who tells me, hey, you got 90 days to get out of your apartment. Oh. So here I was with about to have no place to live and a business that's imploding in New York City. And I needed to figure out what was I going to do? How was I going to get myself out of this bind? How was I going to find a place to live with no job and no prospects? I ended up getting a job. I went in-house at Showtime, the cable television channel. They were a client of mine. They offered me a position in-house. And I was looking for a place to rent on the Upper West Side of Manhattan, ended up buying a co-op up in Washington Heights, which is about 30 minutes north. And the reason why my sister had lived up there, and she saw a little ad on a bulletin board for a co-op that was for sale. So I bought the place. 2.5 years later, I sold that property and saw my initial investment more than quadruple in value, right? So I had this amazing return. And I said to myself, wow, first. And then I said, how do I do that again? How can I keep doing that? Because it was amazing, the return that I got off the real estate. And that's when I first got involved. And I did real estate as a hobby then for about 10 years. And then about 6 years, a little over 6 years ago, I started doing it full time. So I've been a full-time real estate investor for a little over 6 years now.
Awesome. And what kind of real estate do you do? Is it like multifamily? Like what kind of real estate?
Yeah, I focus on multifamily deals. I use a syndication model. So for anyone who doesn't know what a syndication is, a bunch of investors get together and we pool all of our funds together to go ahead and buy those properties. And so 2/3 of my portfolio, I have a pretty large portfolio, 2/3 of that are deals that I'm a passive investor in. So I'm a limited partner. I give my money to somebody who is running the deal, someone that I trust, that I've done a lot of research on, that I like. And so I will invest through them. And then 1/3 of my portfolio, a little over 2,300 doors, are deals that I am the general partner on. I'm an active investor in. And so that means I'm involved with everything from acquisition through the due diligence, closing on the property, and then managing that property on a at least weekly, if not daily basis. I mean, we have property management in place that's dealing with the day-to-day with the tenants. I'm not physically at the property, but I'm the asset manager, making sure that the property management is doing a good job and hitting the KPIs or key performance indicators that we've put together for the property to follow our business plan.
Okay. Now, let's say, for example, you're in the process of investing in a different deal as a limited partner. What are some things that are running through your mind as far as trust? Like, what are you looking for?
I'm glad you asked that question, because those are some of the things that I address in my book, Backstage Guide to Real Estate. In the book, I go through my journey in real estate and bring out the 18 different keystone concepts that I learned on my journey to where I am today, starting with really basic stuff like what's the difference between an asset and a liability, all the way to things now like did an air rights deal and a 1031 exchange. And in the back of the book, I have a section specifically about passive investing and questions to ask, because I look at three things when I'm looking to do a deal, either as a passive or usually as a passive investor. I look at these three things. I look at the sponsor, so that's the person who's running the deal, the market where the deal is located, and the deal itself. So you had asked specifically questions about the sponsor. And so some of the questions, the first question that I would always ask everybody if they ask me about a deal, I say, how did you meet the sponsor? Because that's a really important thing. If it's somebody that you met at a local meetup or some real estate conference or something like that, that's probably a good sign. If you met somebody, you know, Sari, if you told me, hey, you got to meet this guy, I'm just going to make up a name, Joe, you got to meet this guy, Joe. He's a great syndicator. I just, you know, I've done a couple deals with him and got great returns, wonderful communication. Like that's a referral that I want, right? That's someone I'm going to call that guy Joe, right? And find out what he's doing and try to get involved in his deals. The other side of the coin might be, oh, you get a spam email or some random message on like Facebook or LinkedIn from somebody that you don't know. You don't have any mutual friends in common, right? That makes me raise an eyebrow. Okay. Now, I'm not saying that the person isn't legit and then it's not a good deal, because maybe it is, but my experience has told me that I should be pretty cautious in that kind of situation. And so that's what I do in the book. I give people ideas of things to look for, to kind of be wary of, but I never tell anyone to definitely do something or not. So that's one of the things I want to look at a sponsor. I also want to see if they have a track record. What have they done in the past? And maybe they don't have a track record in real estate. You know, I had my first deal, right? Everybody has a first deal that they do. So I don't want to say not to give somebody a chance, but I'd like to see some other sort of business experience that might be parallel. I'll give you an example with myself. I started off when I worked in the digital advertising world. I was a project manager. I'm a PMI certified project management professional, which means that they gave me a certificate to say that I know how to manage budgets and people and timelines. And I did that for 18 years for big clients like Visa, Verizon, Coca-Cola. So I was doing that and doing real estate as a hobby for 10 years. So when I transitioned into doing real estate full time and I had my first deal that I was bringing to people, I think a lot of the people that I know that knew me from business or knew me personally, it wasn't a big stretch because I'd been doing it successfully on a part-time basis, and they all knew that. And also, I'm just really good at managing people and budgets and timelines. So it made sense. I also brought on a co-sponsor on the deal with me. So I didn't just do it myself. There was two of us. And that person had a lot of experience having done these deals. I think at the time he had done about 10 real estate syndications. So that gave people, I think, the confidence to feel good about it. In my first deals, I didn't get involved in people's first deals because I felt like I wanted them to have a little bit of experience. So the first few deals that I did that I invested in someone with more experience. Then I started feeling more comfortable being able to look at underwriting and discern whether sponsors would be good or not. And sometimes I'm wrong, you know, I mean, honestly, like most of the time I do a pretty decent job, but you know, there's always people that slip through the cracks. But I don't know that I've ever invested in a deal where everybody on the sponsorship team, because there's usually more than one person, we're all complete newbies, because that's kind of a little scary. You want to have at least one person with some experience under their belt. Got it. Okay. And back to PMI. So I actually, when I got my MBA, I got it with a focus in project management. And I took we had my grad school had an affiliation with PMI, the Project Management Institute. So I was actually on that route to becoming a PMP. And yeah. And for those who don't know, I could tell you that
PMPs are very good at planning. And so that's so my question is then, do you see any correlation between the PMP subject matter and managing real estate deals?
Well, PMBOK, which is
Yeah.
the Project Management Book of Knowledge, for
Uh-huh.
those who don't know, right? The PMBOK is, I actually have one right over there on my my bookshelf. It's a big, thick book.
Mhm.
And what it does is really interesting. I have been doing project management for a number of years before I ever took the course. And by the way, you have to be doing it, I believe it's for 5 years as a
Yeah.
professional before you can even take the exam.
Mhm.
And then you have to take do a course of studies, and then you have to take this exam. And it's one of those things like where they bring you into a testing facility and pat you down, make sure you didn't put any cheat sheets in your, right? They do. You have to
Yeah.
take your coat off and put it in a locker and everything. I was so nervous for that test, but I passed with flying colors. So anyway, with that, what it really does is it codifies project management. And I found it fascinating because I don't think I learned anything
Yeah.
by taking the class, except I learned what everything was called. I was like, oh, that's what that's called.
Yeah.
Now I understand. So it's nice because it gives people in that field, in the project management field, a lexicon, right, with which to talk with one another, which is fantastic. And it also makes sure you know what you're doing. I am a planner by nature, but I do use a lot of the tools and techniques that are codified in the PMBOK that I learned through 18 years as a professional project manager in the work that I do on a daily basis. So I have a spreadsheet with all those different KPIs. That's all stuff that I developed through the years for managing digital marketing projects and advertising projects. I have modified it, right, to fit into real estate, but the essence of what that is really came from that. And I just think a lot of the skills and a lot of the soft skills that I learned as a project manager, which is really a lot of the stuff around people management, are things that I use on a daily basis.
Got it. Definitely. And then what are some of the KPIs or key performance indicators like in real estate?
Oh, well, so what we're looking at on a weekly basis, we're looking at our occupancy, at the property. So physical occupancy and economic occupancy, what our occupancy trend is looking at for 30, 60, and 90 days. So we can see, oh, it looks like a whole bunch of people are leaving. We're going to have a problem 3 months from now. Let's do something to amp up our marketing activities and get more people coming in. That's another thing. We look at traffic coming in. We look at how many leases were signed. We looked at renewals. Renewals are really, really important. A lot of the work that we do is a value add. So one might think, oh, you want people to leave so you can upgrade that unit and then rent it out at a higher price, which is what we do on a lot of our things. We're buying properties that were built in the 70s or 80s. They're really dated. We go in there, we fix up the properties, make them look nice. And, you've got an interior from 1980 with like a white fridge and an avocado colored, oven. And it's just all mismatched and just, it looks really bad. And we go in and make it look nice and modern and well put together. But honestly, we don't want everybody to leave. We want happy residents to be there, especially if they're good residents in a good part of the community. And so one of the highest costs is that turnover, is when somebody leaves and we're bringing somebody new in. So we want to see renewals, and so we have KPIs on the renewals and renewals for this month. And just like on the occupancy, we have 60 and 90-day trends on that. We look at how many work orders are out there, right? If there's a lot of work orders, and we have work orders less than 72 hours and longer than 72 hours. So it's been over 72 hours and somebody's work order hasn't been addressed. That's like someone might have a toilet that's running or some sort of problem in their unit. If we have a lot of work orders that are taking more than 3 days to get fixed, we have a problem at that property, and we're going to have a problem retaining the tenants and having happy tenants. We want to make sure we're providing a really nice place for people to live. And don't get me wrong, this is not the Taj Mahal. I'm not buying A-class properties, right? We're buying C-class properties and B-class properties, skewing more towards B and more these days. But we want to have a nice, clean place for people to live where they're happy living.
Mhm.
And so that's why work orders are very important. And those are some of the KPIs that we're looking at on a weekly basis.
Got it. And then you mentioned like when people are leaving, it tends to cost you more because I think one thing that came up to my mind is you have a leasing company or a broker, right? A real estate broker that helps you find new tenants, and then they typically take like the whole month's lease, right? So right there, that's a
Well, it's actually a little bit different on the properties that we do. I think you're right. On a lot of properties, you will
yeah,
have that. I have a 6-unit property, and they
yeah.
do that. The property management company
Mhm.
takes a month worth of rent as
Yes.
their leasing fee. Um, we have on-site staff for these properties
Okay.
because we're generally buying properties that are at least 100 units. We're usually buying two to
Yeah.
400 unit properties. So because of that, we're able to have full-time property manager, a
Hmm.
full-time leasing manager, usually some assistant people for leasing and
Hmm.
property management. And we have a full-time maintenance team with like 2 to 4 different maintenance guys. So because of that, we don't have to pay per lease.
Got it.
We do pay them a salary though. They have a salary. They have a certain amount of leases they're supposed to hit every month.
Hmm.
And if they go above that, we do bonus them. We give them a bonus, but it's not like a full month's worth of rent because they're salaried. The turnover cost is just expensive because whether we're renovating the unit or not, we have to make sure the property looks nice. If someone's been in a unit for, let's say, 4 or 5
Yeah.
years, their carpet maybe gets worn, right? But they've been there and it's gotten worn gradually over time and they don't really necessarily notice it or complain about it. And, it's fine. But if they leave and we need to show it to someone and there's stains in the carpet and it's all worn down, that's a problem. We're going to need to replace it. And then we make a decision on whether we want to replace it with carpet. A lot of times we'll go ahead and upgrade that unit and put in the vinyl plank flooring.
Uh-huh.
But in any case, we're looking at a few $1,000s depending on
Yeah.
the size of the unit and the materials that we're using. So, I mean, it's probably going to be somewhere between $2,000 to $4,000 worth of work. That's just the floor. And then maybe it needs a new coat of paint. Maybe we need to resurface the countertops. Maybe, I'm not even talking about a whole new appliance package if which we could do, but I'm just talking about like, even if we're not upgrading, you're still probably going to need a paint, at least touch up paint, if not a full new paint, depending on how long they've been there, and flooring.
Mhm.
Those are the two big things. And the countertops. The next thing you're spending $4,000 or $5,000 on a unit to turn it. So it just depends on the particular situation, but it makes a lot more sense for us to keep somebody in a unit and maybe they're paying $100 a month less than what the market rent is for
Yeah.
someone who's moving into a new unit. Okay, so that's $1,200 a year that you're losing, but that sure beats spending $3,000 to fix it up because
Yeah.
you'd be at a net loss. So it just depends. We do want to upgrade a certain amount of the units, but we don't want 100% vacancy and have everybody leave and the turnover. And that's the other thing is the vacancy cost. When nobody's in there and you're fixing up the unit, those are days that it's not rented and then you have to rent it out. So, maybe you have a month or 2 or 3 where your unit is vacant and you don't have any income.
Yeah, and every day there's expenses. Just because the tenants are there doesn't mean the expenses stop. You still have to pay insurance, property taxes, your mortgage, the principal, interest, all these, right?
That's correct. And even more so, you have to pay the utilities when it's vacant, right? Because you're still going to need light and water while your maintenance team is in there making those changes. So now you have utility bills as well.
Mhm. Okay, got it. Yeah. And where are these properties located?
So we invest across the entire United States, but most of the properties that I have as a general partner are in Texas and specifically in Houston and Dallas, and also in the Kansas City area.
Okay, but not in New York City. Would you say that's not really that good of a market for syndication?
For the kind of things that I do, I would say no. I love New York City. I live here. I own the building that I live in, which is really cool.
Yeah.
But in general, the Northeast doesn't seem to, the numbers don't seem to work out. And there's always exceptions to the rule, but as a large majority, they don't seem to fit into the same sort of model. And so let me explain that a little bit, Sari. I look for cash flowing properties.
Yeah.
Okay. I mentioned the Keystone concepts in my book, and Keystone concept number 5 is cash flow is king.
Yeah.
So as you know, I mean, you're a financial advisor, right? I'm sure you tell everybody this, that markets go up and markets go down, and we can't predict when they're going to go up or when they're going to go down, or how far up they're going to go or how far down they're going to go. And so real estate is just like the rest of the economy, just like stocks and bonds. I mean, it has cycles, right? And as long as I have a property that is providing me with cash flow, I almost don't care what the value of the property is at any given time.
Yep.
I mean, I do care, but it doesn't really matter because I know that another year from now, it's going to have a different value. It might be more, it might be less. If I have a property that's giving me cash flow, so producing income for me, that's what I really, really care about. Now, I do want it to go up in value over time. Don't get me wrong. I want it to at least keep pace with inflation, but hopefully outpace inflation. But the most important metric for me is that cash flow. What does that look like? Because what I'm doing, I'm buying a business. The business happens to be an apartment building, but I'm buying a business, and I want the business to be profitable and send me checks every, month or quarter or whatever, or ACH it preferably. I don't really like checks anymore. I'd rather just have it magically appear in my bank account. But that's what I'm looking for. Okay. And so having that cash flow, that'll give you some resiliency that you might need, because if the economy does dip, right, you may need to pull back on the rents a little bit. You might have a little bit more vacancy. Those kinds of things happen. So maybe your cash flow goes down a little bit, but that gives you that cushion. You have some comfortability there as you're moving forward. And so I can't really find those in the Northeast markets or on the West Coast, honestly. Those two, the East Coast and the West Coast in general, and when I say East Coast, I'm really talking about Northeast, they tend to be really great markets for appreciation. And you can buy a property and it's not necessarily going to cash flow, but hopefully in the long run, it'll do well. That I used to live in Boston for 4 years, and I cannot think of a better market, honestly, for capital preservation. If you've got $10 million and you just want to put it somewhere safe where it's going to keep up with inflation, you might want to look at Boston, right? Because you can park your money there. It's got such a diverse economy there, different industries. It's a wonderful, wonderful real estate market as far as I'm concerned. But you are going to be very hard pressed to find something that you can buy in Boston where you're going to have cash flow. And the kind of cash flow I'm talking about is I like to see deals where my cash flow is between 8 to 10% cash on cash return. That's what I want to see. And a lot of the deals in Boston I mentioned earlier, I know you have something that you want to say, which is real quick. Because I saw you open your mouth. The 6 unit that I mentioned earlier, I bought that. I had a 1031 exchange. I needed to find something to buy, and I wanted to buy something in Boston, and I couldn't find anything that cash flowed. So I bought a 6 unit in Kansas City that cash flows wonderfully.
God, okay. And as you were talking about capital preservation, just having a property appreciate, not necessarily the cash flow. I was also thinking of California and the Bay Area. Is that also similar? Where it's really good for appreciation, but not so good for cash flow?
I think that is correct. I know a number of investors who live in California who do not invest in California. They're investing outside of the state of California. There's other factors that go into this as well, such as, tenant landlord laws, right?
Yes.
That's one of the things that people want to look at. And also taxes. The taxes in California, as I've heard anecdotally, and I don't know, and I'm not a tax advisor, but I heard the taxes are really high there, so that it makes it difficult for a lot of businesses. And I've heard that that's why a lot of businesses have been moving from California to places like Texas. And that's where we invest in a lot of property. One of the reasons why we really love Texas is employment growth is off the charts. I mean, they have really, really great employment growth, and a lot of companies are going from California to Texas and opening up headquarters there or just different, additional offices there. And people go to where the jobs are.
Yeah, definitely. And taxes as far as property taxes and income taxes, right? Both types of taxes.
Yeah, and corporate taxes I
Yeah.
think are pretty high
Yeah.
in
Yeah.
California as well.
Yeah.
Again, I'm not an expert. I don't own any property or really
Hmm.
conduct any business in California, so I'm
Yeah.
not certain, but that's what I've heard.
Yeah. Yeah, for sure. Yeah, definitely. Yeah. Let's talk about your book. So what's one more time? What's it
Oh,
called?
it's called Backstage Guide to
Uh-huh.
Real Estate.
Okay, perfect. And pretty much if somebody wants to get into real estate as an active investor or a limited partner, they could check that your book would help them with that.
I think so. And I think it's going to help more the passive investor.
Uh-huh.
I think it's great for active investors as well. As
Okay.
I mentioned earlier, I start off super basic
Yeah.
with things like what's an asset and what's a liability. And then I go through, flipping houses and then getting into syndication. And then I talk about a syndication deal gone wrong. I
Mhm.
talk about my first syndication deal. And then I talk about an air rights deal. And I talk about a 1031 exchange. Those are actually the same deal, the 1031 and the air rights deal.
Okay.
But it's such a complex deal. We had to do 2 chapters to kind of break it up a little bit. And then at the end of the book, there's that backstage, what I call the backstage toolbox.
Mhm.
So the toolbox consists of a few pages talking about how to quickly size up a syndication with some questions to ask.
Mhm.
Then I get into a thing called the backstage tour of syndications, where I talk about a lot of technical things such as cap rates, rental growth, household income, all kinds of like nitty gritty stuff
Mhm.
when it comes to syndications. And then I have a little recap of the keystone concepts. And then I have a glossary. I have the backstage glossary. And so what that is the culmination of all the real estate terms that I define in the book. In the book, I have 60 different real estate terms that I define as we're going through the book, but then I pull them all together at the end as a glossary. It's also an index.
Mhm.
So I foresee this book as something that someone to keep on their shelf, and
Mhm.
they're looking at a syndication deal. They can crack it open and look at some things. And maybe there's a term and they're like, oh, I don't remember what that term is. They can go to the glossary, read the definition, and it tells them what page we discuss it. So they can go back to that chapter and read that little section if they want a little more context around it. So that's how I envision it being used. We'll see if people use it that way. I hope that they will. I hope it's a good resource for people to use. That's the reason why I wrote the book.
And where's the book located? How can they find it?
Well, the book is available on every single platform you can imagine, including Amazon. It's available. The best way to get it, though, I think, is to just go through my website,
Mhm.
Picheny.com. I'm sure you'll put that in your
Yes.
show notes,
Mhm.
but if you go there, you can click the link to you can read more about the book there, and you can also click the link to buy it. I also have a bunch of great resources on the website. I have a blog with lots
Mhm.
of information about real estate and real estate investing, and I have a newsletter you can sign up for. I send out every month with investing tips,
Mhm.
things of that nature. So it's a good resource. I hope the website.
Yeah, absolutely. Yeah, definitely. I'll put in all the links in the show notes below. That way we just click and find you. Are you active on LinkedIn?
I am. I'm on LinkedIn. Yeah,
Okay.
I'm on Facebook too, but that's got a lot of pictures of my kids. So if you want to see adorable kids, you can go there and see my real estate stuff and my kids. But LinkedIn, I keep just for the business stuff.
Absolutely. Yeah, I'll put your LinkedIn profile. And Matt, thank you so much for joining us. I had an awesome chat with you, and I look forward to bringing you back on the show.
It was a pleasure. Thanks for having me.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.